In my last episode, we discussed that the Federal Reserve Bank has been backed into a corner, and that given the current economic circumstances, we are most likely going to face a global depression within the next 10 years. This is mostly due to excessive amounts of global debt throughout the economy, from businesses to households, from personal debt and government debt. In this video, I will try to answer two questions. How do we end up in this predicament? And more importantly, will we have severe inflation or deflation in the coming years? The answer may just surprise you. How do we get here? Generations are not created equally. The challenges and opportunities that come with each generation are unique. The people who lived through the Second World War were the silent generation, and their children, the baby boomers, are the main reason we are in such a precarious position today. The baby boomer generation is by far the largest growth of population in history. They lived through the fastest economic growth in the world that will most likely ever exist, with the end of the Industrial Revolution and the start of the Information Age. They also lived in the most peaceful time in human history, saving them a lot of money. And finally, due to the peace and the advancements in medical technology, people live a lot longer today than they did at any time in history. I won't dive too deep into these topics because the video would be over an hour long, but my point is the baby boomer generation and the preceding silent generation are insanely rich by all standards. But in a debt-based monetary system, it is not about how much gold you have in the bank, but rather how many assets you own that determines your wealth. Keeping your money in the bank is too expensive due to it being eaten away by inflation. It is far better to invest your wealth than to save it. Investing is a tricky business. Three factors play a major role in what is seen as a good return on investment. The first one is access to capital. The second one is access to investments. And the third is risk of an investment. Let us look at the first part, having access to capital. Suppose 5 businesses require capital to grow their operations, and only one investor has capital to invest. In that case, he can get a very high return on his investment because he can choose where to invest his savings based on who gives him the greatest return on investment. So let's say that Jim decides to invest in a bicycle shop because they are willing to give a return of 20% per year. The second factor we need to look at is access to investments. What if there are still 5 businesses that require capital to grow their operations, but now there are 20 investors who want to grow their savings by investing into these operations? The return on investment would be far lower now than it is previously because now the businesses are the ones that have easy access to capital. Where the bicycle shop was willing to pay 20% per year, they are now only willing to pay 5% because they can easily get the capital from somewhere else. The third factor we need to look at is risk. Let's look at the 5 businesses again. We can see that there is a frozen yogurt shop that is willing to give 35% per year. But Jim decides to not invest in it because frozen yogurt tends to be a trendy product and it comes with a higher risk because maybe next year it is out of fashion and people no longer want to buy frozen yogurt. Let us bring all these factors together and look at some real-life examples. In developing nations such as China, you have an excess of opportunities and a shortage of capital. In developed nations such as the United States, you have an excess of capital and a shortage of investment opportunities. This sounds like an easy problem to solve. People from the United States should invest their capital into China. Unfortunately, risk is the limiting factor. Robert Kiyosaki invested in a company that built a gold mine in China. Unfortunately, when the project became successful, it was taken over by the CCP. This is not an exception, but the norm. Countries with sound laws and regulations, especially regarding financial systems, normally have an excess of capital and a shortage of investment opportunities. Countries that are prone to corruption, are communistic or run by a dictator, that don't have trustworthy legal or policing systems, normally have an excess of opportunities and a lack of capital. As is always the case in finance, prosperity is built on trust. The baby boomers are now retiring or completely retired, so the majority of their capital is invested in new opportunities with the younger generations. Unfortunately, there is a shortage of opportunities because the younger generations are smaller in size and less productive, with fewer economic opportunities. Because of this imbalance, access to capital for the younger generations is very easy. So, to put it broadly, interest rates are therefore very low. The lowest that they have ever been, historically speaking. This is a bad thing for the following reasons. With low interest rates, even highly volatile and risky businesses have access to capital. So, the frozen yogurt parlor, in our example, would have enough capital to fund operations, even though their operation is of higher risk. A real-life example of this is that we may have too many coffee shops. Now, this may not sound like a problem because everyone loves a good cup of coffee, but when an economic disaster strikes or a global pandemic, coffee is the first to go. And when 50% of your economy is built on just basic service jobs that no one truly needs, you find yourself in a predicament. If interest rates were higher, those same employees would rather be working in manufacturing, agriculture, and construction, things that you need or improve your quality of life over time, because those businesses inherently have less risk. Secondly, with access to debt easily available, people live beyond their means. If you had a credit card with a credit limit of $1 million, how much would you spend if the interest rate was 3% compared to 10%? If it were me, I would take the entire amount and just invest it into the broad stock market, because historically speaking, stocks grow at more than 4% per year. Is this not exactly what happened when everyone refinanced their home in 2021 at 3% per year for the next 30 years, taking out a mortgage on their home? People used that extra money to prop up financial assets, thinking that they would make money in the long run. All this extra money did push the S&P 500 from $3,200 per share to $4,700 per share, but did the economic output or profitability of those companies increase by 30%? Of course not. Prices went up because of speculation using debt, enabled by low interest rates. Third, when interest rates are low, people who have access to capital use leverage to generate high returns on their investments. Let's look at the UK pension fund crisis in 2022 as an example. UK pension funds bought UK bonds to create a safe and stable return for their members. But because interest rates on those bonds were too low, they would not be able to pay out the benefits that their members expect. So, the pension funds borrowed capital to purchase more bonds so that they could easily increase their return on investment, using leverage. When the price of the bonds started to crash due to political unrest, banks started to liquidate the position of the pension funds' portfolios because they had substantial losses and were underwater at current market valuations, causing a negative feedback loop where bond prices lowering leads to more bonds being sold, which leads to bond prices lowering. The pension funds wanted to hold the bonds till maturity and not sell early, but because of leverage, they were forced to take a loss and sell their bonds early. This is until the UK government came to bail them out, stopping a complete implosion of the UK bond market. So in summary, wealthy previous generations leads to low future interest rates that leads to excessive amounts of debt and pending financial ruin. There is only one question left to answer. Will everyone default on their debt, leading to a deflationary depression, or will governments re-stimulate their economies by devaluing their currencies, leading to an inflationary crisis? Governments would rather print money than raise taxes or default on their debt. So it seems obvious that there would be large-scale currency devaluations leading to massive inflation. But with the total amount of global debt in all sectors being so high, governments can print trillions of dollars and it would not be enough. As a fraction of total world debt, government debt is a very small percentage. So the majority of institutions and people will default on their debt, leading to a deflationary depression. If you have any questions, leave them in the comment section and I will try to answer them in the next video. I will end with one final quote. Hard times create strong men, and strong men create good times. Good times create weak men, and weak men create hard times. My name is Jonathan, and thank you for watching this episode. I will see you in the next one. Goodbye.